Hello and welcome to this is our first demo video. So for those of you that had me last semester, I'm pretty much going to do the same thing. For your homework, you have to do problem 10-2A, problem 10-4A, and problem 10-7A, right? Those are right out of the book, okay? What I wanted to do was walk through those same problems, but looking at the or the B problems. Okay, what this will do, hopefully, should set you up for success to do your homework. Should hopefully clean up any questions that you may have with regards to calculations and things like that. Okay, so if you've done your homework already, please follow along with the video because you might catch a mistake that you made, and that's a good thing. Okay. So what we have here is problem 10-2B. Darnell Company purchased three machines, machine 1, machine 2, machine 3. Notice they were acquired at different times. One was acquired at the beginning of the year of 2012. Machine 2 was acquired at the beginning of the year in 2013, and machine 3 was purchased in November of 2015. They give us the cost, they give us the salvage value, they give us the useful life, and they tell us, hey, we're using three different depreciation methods. Okay, that's fine. We can do that, right? We can have machine 1 that does straight line. We can have machine 2 that we use double declining. We can have machine 3 that uses units of activity. Okay, you can do this in the real world. The only catch is if you stick with one method, or if you do one method, you pretty much want to stick with that method, right? You wouldn't want to go from straight line to double declining or double declining to straight line. The method that we use is based on it's based on management's choice, okay? And the idea is that management tries or should try to allocate the cost of running that machine to the revenue that it generates. Okay, so maybe straight line might be a good method for one machine. A second machine, well, maybe double declining would be a better method to use, right? So again, the takeaway here is you need to know how to calculate all three. When it gets to the real world and you're out in corporate America, they may have a policy on which one they decide to use, or they might say, you know what, we're going to do it on a case-by-case basis, trying to determine which method best allocates the cost of the machine to the revenue that we generate. And it goes back to that matching principle, right? The expense recognition principle or the expense matching principle. They give us some more information, right? They tell us that the units of activity for the machine is based on machine hours, and they expect to run 25,000 hours, or they expect to get 25,000 hours out of this machine. Okay, and then they go ahead and they say, okay, here's the depreciation, or I'm sorry, here's the actual hours of use for the first 3 years of this machine. Right, we'll need that for machine 3. Why? Because we're using the units of activity. Okay. So what I already went ahead and did was I kind of created a little bit of a spreadsheet or Excel spreadsheet, and I'll show you that in a second. The instructions, they want us to compute the amount of accumulated depreciation for each machine as of 12/31/2015. That's part A. Part B says if machine 2 had been purchased on May 1st instead of January 1st, what would be the depreciation expense for this machine in year 2013 and in year 2014? We'll take care of that in a second. Let's just focus on A. A wants us to basically calculate accumulated depreciation over a number of years and give our total. So the first thing I did was I went ahead and I pulled up an Excel spreadsheet, and I just kind of set everything up that the way the problem gave it to us, right? They gave us machines, the dates that it's acquired, the cost, the salvage value, the useful life, and the method. Okay? Bear with me here. I want to add a couple rows, or a couple columns rather. Okay, so first thing we should do is figure out what is the depreciation expense per year, right? Because accumulated depreciation, remember, is that bucket that holds all the years of depreciation expense, right? So I just want to figure out what is the depreciation expense. Usually helps if you can spell too. Okay, so in order to do this, actually let me do it this way. In order to calculate depreciation, we need to figure out what is our depreciable cost. How much of this cost can we depreciate? Okay, and in order to figure that out, we need to take our cost and we need to subtract our salvage value. Okay, so we're going to look at, just looking at straight line, we take the cost of $105,000 and subtract out the salvage value of $5,000. And again, we're just looking at machine 1 here. I end up with a depreciable cost of $100,000. Okay? What about for double declining? Can I figure out depreciation cost each year? I can. Can I do it this way, the way it is? No, because each year the depreciation expense is going to change. Excuse me. So I can't use that, right? When we're using our double declining method, what is our depreciable base? Well, our depreciable base is the cost, right? Because remember, when we depreciate this, the ending value of our machine is going to be whatever the salvage value is. So, in machine 2, technically, the depreciable cost is $170,000. I got that by taking $180,000 minus my $10,000. Okay, so that's the amount of cost we're going to depreciate. Okay, and then I do the same thing with machine 3. Machine 3 uses units of activity. I'm going to do the same thing. So I'm going to take my cost of $125,000 and subtract out my salvage value. I get $110,000. Okay, so what is my depreciation expense per year for machine 1? Super easy. I take my depreciable cost of $10,000, or I'm sorry, $100,000, and I divide it by 10 years, which is that useful life. I get $10,000 per year, right? Can I do the same thing for double declining? No, because depreciation expense is going to change each year, right? Based on our book value of that machine, okay? For units, can we do units very easily? We sure can. Notice the machine is supposed to last us 6 years. But if we go back to our book, they tell us that, oh, hey, by the way, for the units of activity method, total machine hours are expected to be $25,000. So because we're using machine 3, our units of activity that we're using is going to be based on hours. So I'm going to go back to my spreadsheet, and that life of 8 years, 10 years, 6 years, that really doesn't help us for units of activity, right? Because I need to put in what is the estimated activity. So I'm going to get rid of my 6 and I'm going to put 25,000. Okay, that means 25,000 hours. Oh, by the way, if you're using big numbers, please use your commas and get rid of any decimal places. Okay, so let's look at the depreciation expense for machine 3 using units of activity. To do that, I take my depreciable cost, which is $110,000. Again, I got that by taking my cost less my salvage value. From there, once I get my depreciable cost, I'm going to divide that by my units of activity, right? Or the life of 25,000 hours. Because instead of years, since we're using units of activity, we're going to express that life in the form of hours. So I'm going to divide by the 25,000 hours. I get 4.4. Okay. I know I said get rid of the decimal places, but if we have something that rounds off like this, we're going to keep that. Okay. So my depreciation expense for machine 3, which uses units of activity, is going to be $4.40 per hour. Okay? So now we can answer the problem. Part A, right? What does A want? A wants our accumulated depreciation. So I'm going to say machine. We have machine 1, machine 2, and machine 3. Okay? What is our accumulated depreciation? Well, it all depends, right? It's going to change. It's going to be changed differently. For machine 1, we're using straight line. Okay? So I'm going to take my depreciation expense, which is going to be $10,000, and I'm going to multiply that by 4. Is it 4? Yeah, it's 4. Okay. Bear with me here. Okay. You might be saying, where in the world did you get 4? Well, let me show you. You do not need to do this for your homework. I'm doing this just as a demonstration to show you what I'm talking about, and hopefully this will help you out or clear up any misunderstanding. Okay, so let's think about it this way. So we have right here this first block, or first dash, is 1/1/2012. Well, we have depreciation that we need to take for 2012 because that was the first year we bought it. We need depreciation for 2013. We need depreciation for 2014. And we also need depreciation for 2015. Okay? So my depreciable cost is $10,000 per unit. Okay? Or per year, excuse me. So that means in year 1, I get $10,000 of depreciation. Year 2, I get $10,000. Year 3, which is 2014, I get $10,000 of depreciation. And the final year, year 4, I get $10,000 of depreciation. Okay? If I go ahead and add all these up, I get my $40,000. Okay? So that's the answer to A, right? Now to B. We're using double declining. Not that easy to use, right? We can't just do a quick calculation and plug it in. We got to create that chart for double declining, right? So we want to start off with the book value. We want to figure out what our rate is, and we also want to figure out what our depreciation rate is, or our depreciation expense is for that year. And we also want to do the same thing for accumulated depreciation. And then at the end of the year, we want our book value again. Okay? So this only applies to machine 2. Why? Because we're using the double declining method. Okay? So first thing I want to do is I want to say, well, what's my book value at the beginning of year 1? So I have, we'll say 12/31/2013, I have depreciation. 12/31/2014, I have depreciation. 12/31/2015, I have depreciation. Okay? To figure out what our double declining rate is, notice the useful life of this asset is 8 years. Okay? Let's just go like that. Okay, 8 years. So I need to figure out what my rate is. Well, that's easy. If I divide 1 by 8, I get 0.125, right? That's straight line based on the year. That's the percentage, right? But I need to multiply this by 2. Why? Because it's double declining. I get 0.25. Then I multiply my 25 by 100. And I get 25%. Yeah, 25%, okay? So what's my rate? 0.25, 0.25, 0.25, right? Each year, okay? So let's just go year by year by year, okay? For book value at the beginning of 2013 was $180,000. That's what I paid for the machine. Remember, when we use double declining, we do not subtract out the salvage value. Why? Because at the end of the day, meaning once we get to the total depreciation, or we recognize all the depreciation, the value we have, or the book value, needs to be that $10,000, which is the salvage value. Okay? So what I'm going to do is I'm going to calculate, well, what's my depreciation expense? Well, that's easy. If I take $180,000 times 0.25, I end up with $45,000. Okay, cool. What is my accumulated depreciation? Well, I'm still in year 1. If the depreciation expense for year 1 was $45,000, that has to be my accumulated depreciation for the first year. So I'm going to type that in. Okay. Now we need to figure out what the book value is. Super easy. I take my beginning book value of $180,000 and I subtract my accumulated depreciation for year 1. I get a book value of $135,000. Okay. Year 2. What's my book value? Well, my book value at year 2 is $135,000, right? 1 year's ending book value is going to be the beginning year's, or the next year's beginning value, okay? So my book value at the beginning of year 2 is $135,000. I then multiply that by my rate of 25%. I get depreciation of $33,750. No problem. What's my accumulated depreciation? I take the accumulated depreciation that I have from year 2013, and then I add the depreciation expense I have for 2014. I see my accumulated depreciation is $78,750. Okay, cool. What then is my book value? Super easy. Beginning book value minus my depreciation expense gives me $101,250. Okay? What's my book value for, or at the beginning of year 3? It's $101,250. So at the end of year 3, I got to figure out what's my book value. Well, that's easy, right? If I started the year with a machine that had a value of $101,250, I need to figure out what that depreciation is. Super easy. Take that year, that beginning book value, and multiply it by my rate, 0.25. I'm going to get rid of these cents. So what then is my accumulated depreciation? Well, my accumulated depreciation is the $78,750 plus year 3's depreciation. It's $104,630. What's the book value of my machine now? Well, that's easy. it's the $101,250 minus my depreciation expense. I get $75,938. That's the book value. So, for number 2, they want to know what is the accumulated depreciation for machine 2. That's super easy, right? I have it right here. It's $104,063. That's my accumulated depreciation for year 3. Okay? So we already looked at single line. We looked at double declining. Now let's look at, excuse me, the units method. Machine 3. So we're looking at machine 3. Okay? So for machine 3, we need to figure out what our what our depreciation is per hour. We already did that. That was $440. The next thing we need to know is how long did this machine run for for year 3, or for year 1, machine 3, right? So if we go back to the book, they tell us that, oh, by the way, actual hours of use in the first 3 years were 2015, we ran the machine for 2,000 hours. 2016, 4,500. 2017, we ran the machine for 5,500. Gave us way too much information, right? All we need to know is how much did the machine run for 2015? How many hours did we use it? We used it for 2,000 hours, right? Now, notice we bought it, the fourth quarter? We bought it in the fourth quarter of the year, right? We bought it in November. So that means November and December, we only get depreciation for, right? Those 2 months. You might be thinking, oh, okay, I got to take the year and then break it down based on, 2,000, based on, 2 months out of the year. That would be correct if we were using straight line. We're not using straight line. We're using units of activity. So we can assume that 2,000 hours that the machine ran in year 2015 represents November and December. So all we need to do to figure out the accumulated depreciation for machine 3, we're going to take our depreciation expense per hour and then multiply it by 2,000, because that's the actual hours we used the machine. We get $8,800. Okay? So that's how you do part A. Part B says if machine 2, okay, that's this one right here. If machine 2 had been purchased on May instead of January, okay, what would the depreciation expense for this machine be in 2013, and what would it be in 2014? Super, super easy, okay? So let's go to B. And I found that setting up the problems makes a lot of sense, right? So bear with me here. Okay, so I got 1 through 12, right? Those are my years, or those are my months, my months. January, February, March, April, and May, okay? So what they're saying is, what is depreciation in year 1 if we bought the machine in May instead of January, okay? So what we're going to do in this problem is compare the answer we get with what we calculated in our double declining table, right? Because think about it. It's saying here that our depreciation expense for year 1 is $45,000. That's because we assumed we bought it on January. Now what they're telling us is they're saying you didn't buy it on January. How would it change if you bought the machine on May 1st? Okay, so I'm going to do the same thing. In fact, I'm just going to copy and paste this right here. Okay? And what we want to do is we want to look at our our table here, right? January through December. They told us that previously, what we already figured out up here is that we get the whole year, right? Not the case in problem B. We didn't buy it on January 1st. We bought it right here on May 1st. So May, June, July, August, September, October, November, December. So I need to take all those months, right? So that's 1, 2, 3, 4, 5, 6, 7, 8. Okay, 8 months worth of depreciation. Okay, or we could say 8/12. That's not right. Eight twelfths. Bear with me. Okay, that's the depreciation amount that we need to take in year one. Okay, so what's the book value? Well, the book value is $180,000, right? That did not change. What's our rate? Our rate's still the same. It's still 25%, right? What's our depreciation expense? Bear with me here for 1 second. Okay, so we want to figure out what is our depreciation expense, right? So we know for the year, our depreciation expense should be $45,000, right? And that's basically taking the 180,000 by the rate of 25%. But we need to remember that we're only getting, 8 months out of the year, right? May, June, July, August, September, October, November, December. 8 months, okay? So if I take 8 divided by 12, that gives me basically 66%, okay? So what I'm going to do to figure out my depreciation expense, I'm going to come here and I'm going to say equals my book value, times my rate, but then I need to multiply that by my percentage of 8/12, right? My depreciation expense is $30,000. Okay, that's a depreciation expense in year 2013. Okay, I got to carry it all the way out. What's the accumulated depreciation? Well, 180,000, or actually, bear with me. Accumulated depreciation is going to be 30 grand, right? So then I take my book value or beginning year book value of 180,000, subtract out my depreciation expense. I get a book value of $150,000. So now I need to recalculate 2014 depreciation, right? Why? Well, because it's based on book value. My book value is different now because I assumed that I'm only taking basically 66% of year one's depreciation. So my new book value, or beginning year book value as of year 2014, is $150,000. What's my rate? Well, my rate's still 25%. That didn't change. What's my depreciation expense for 2014? That's easy. I take the 150,000, I multiply it by 0.25, I get $37,500 worth of depreciation expense. These are our answers, okay, for part B. This is B1, and this is B2. Okay? That, my friends, is problem 10-2B. When we come back in our next video, we're going to look at problem 10-4B. Okay? So please tune back in for that one.